Good afternoon, fellow traders. I am really delighted to see so many of you already logged on to this webinar and connected. Today's topic is about support and resistance trading in FX. So we'll be essentially going through a few different support resistance levels, how you can apply them, how you can draw them manually on the chart, which I personally do most of the time. And yeah, before we actually go ahead and continue, I want to advise in advance that where I'm at the moment, there is a relatively decent storm outside. So if the webinar disconnects and shuts down, then I might not be able to get back in time and start it up. 2 hours ago, there was an electricity cut out, and the electricity was out for around an hour. So if this happens, then apologize in advance, but it most likely means that I will not be able to arrive back and continue the webinar. Okay, so not to waste your time. Anyways, let's hope that this won't happen and everything will go smoothly. And when the last people are connecting to this webinar, I will quickly go through the disclaimer, so bear with me for a moment. Contents of this material are provided by third party, not hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. All right, so with this out of the way, I want to also mention that at the very end, we'll have a Q&A, so please write down your questions and I will do my best to answer them at the end. And I'll try to be swift and straight to the point to make sure that there is enough time for the Q&A section in the end. In the past webinars, depending on the topic, I sometimes get carried away. I might tend to over-explain a bit, and at the very end, there's only just time for a few questions, so I'll try to speed it up a bit this time. First, I will quickly introduce myself, then we'll go through the two market types you will encounter during your daily trading activities. We'll check the various different types of SR levels and focus on only a few of them, which are most widely used perhaps, the easiest to use, and what we here in our group use the most, okay? Then how to apply the SR levels, theories and ideas into your trading activities, how to manage your risk, and going through some currency trading dangers as per standard as well. So I am one of the senior traders in Blue Sky Forex. We are an education, research, and trading group. And we do provide 24-hour trade support and analysis just to help and allow FX traders to trade safer. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So the two market types that you will come across is price action aka trending market, which is more powerful because in order for the serious price movement to carry weight, in order for it to be tradable, the price movement needs to be fueled by significant news. Okay, so you might have heard the expression "trend is your friend," which is generally true, and identifying the trend, a proper trend, is a bit more difficult than a mean reversion market type because, as I said, like, it needs to be fueled by news, and you will need to be up to date. What news actually can move the markets, and what news are significant enough? Okay. And the second market type is mean reversion. It is more common. It is easier to identify. It can definitely be profitable. Um, and mean reversion market is essentially, I will show you this in a chart as well soon, but it's essentially bouncing between the nearest support and resistance level. Okay, so S1 and R1, this comes into play. Now, just a visual representation of how a ranging and a trending market looks like. At the left side, you have a ranging market. It's bouncing between the nearest support and resistance levels, which are represented by the black lines at the top of the prices. So the top line is the resistance and the bottom line is the support. Okay, so R1 and S1. Nearest support resistance. So as soon as the price reaches the support level, it bounces up, and as soon as it reaches the resistance level, it bounces back down. So the price is really nicely contained within those boundaries between the nearest support and resistance level. Now, after the price has tested the resistance quite enough time, then it breaks out and the trend forms. Now let's pretend that there was some news that actually triggered the breakout and the price started trending in a certain direction, in this case upwards. Okay, we all know that the price never moves in a straight or a linear line. It moves in waves. So here is where Elliott wave theory, knowing it would be beneficial, although you don't have to understand and know it and learn it by heart in order to simply understand that we are dealing with impulse waves and corrective waves. The impulse waves are the waves that move towards the direction of the trend, and the impulse waves are the waves that move against it. And impulse waves are relatively shorter than the trend or the impulse. Sorry, corrective waves are relatively shorter than the impulse waves. Okay, and then that is that what defines the general price movements in waves. Okay, the corrective waves can go up to sometimes even to 70% correction of the very previous impulse wave that happened. So essentially, this is a trend line, and essentially what you could do is simply draw a trend line. I will show how to draw this as well shortly, and essentially trade with the trend as soon as the price reaches the trend line. All right, or the moving average. You can also use a moving average in this case and trade with the direction of the trend. Easy as that. I mean, it's easier said than done, of course, but that's really straightforward. As soon as the trend ends, it goes back into the ranging mode. You see some exhaustion setting in, some indecision, and the price starts to bounce between the nearest support and resistance level again until it breaks out, and the sequence continues. Okay, so this is essentially how market behaves. Really basic, really straightforward. There's also another representation of how the price looks like and how it moves in a ranging market. Okay, again, this is the resistance up and this is the support which is below here. One thing I didn't mention before, that as soon as the price breaks out of that range, this line, or this level that served as a resistance level for this price that bounces in between the support and resistance, this becomes the new support for the price. Okay, so as the price breaks out upwards, the resistance becomes support, and the same happens with the support when the price breaks out downwards. Okay, so this support level comes a new resistance level for the price. Really important to keep in mind. Okay. So this picture also represents what I explained already. It breaks the resistance here, previous resistance, current support, so it becomes a new support. Okay, and then here you can see a new resistance line is defined. Okay, so now into the actual SR levels. There are psychological support resistance levels. I personally consider all the support resistance levels to be psychological because it doesn't really matter whether it's drawn manually or by an expert advisor or by a robot onto your chart, as the traders are still viewing them and recognizing them and trading by them. They are still psychological levels. Okay, if that makes sense. Okay, somebody's saying the screen is black. Let me just pause it for a moment and then initiate it again. It should be good to go. I have no other reports of screen being black, so I'm sure we don't have a major issue. Anyways, psychological support resistance levels, they are considered as round numbers. And whatever support resistance levels you draw on the chart yourself by visually analyzing the price charts. Thank you, Donna, for the confirmation. So it should be only for one user then. And then we have the technical support resistance levels, which are just a few of the examples here is floor support resistance, Camarilla pivots, Woody pivots. Well, then we have the Bollinger Band based non-numerical support resistance levels. If you have been to one of our a Bollinger Band or advanced trading strategies webinars, then you understand how the Bollinger Bands, they really contain the price the same way the nearest support resistance levels do. But these support resistance levels, they are essentially dynamic. So the bonds move along with the price, just to put it bluntly, and then the upper and the lower bonds serve as the nearest support and resistance levels. Okay. Then we have the DeMark and also the Fibonacci retracement levels, which you can consider as support resistance levels. What I will be showing today are how to manually draw and identify support resistance level, and we'll just draw a few support resistance levels at some round numbers and see how these levels have supported or resisted the price movements in the past. Okay, and we can also draw a few Fibonacci retracement tools on the charts just to see how effective these support resistance levels are as well. Okay. Right. Let's see. Joseph is hearing some sound issues. I only have one report, so I'm guessing everybody else is hearing me fine. If anybody else is also hearing me really low volume, then just let me know. I'll try to work things out. Otherwise, Joseph, it's most likely your volume you need to turn up or down, or what exactly is happening there. Anyways, just a picture of drawing the manual support resistance lines. Trend line is one of the manual support resistance lines, which is considered as a psychological line. There's sound problem. Too high volume, not too low. Right. Okay, let me just try to reconfigure things. Sometimes people are saying it's too loud or too low. Now it's people saying too high. Give me a moment. Let me just. Okay. Somebody, and I'm also getting indications that sound is great. I mean, I can't really satisfy all the needs if just want to try to keep it somewhere in the middle then in this case. Okay. Right. So back to the topic. On this chart, you do see a trend line being drawn onto the chart. Now, please note one thing. I actually do need to change the picture. The trend line, when the price is moving downwards, the trend line should be drawn to the lower highs, which means on the top of these candlesticks on the wicks here. Okay, not at the bottom. If the price is moving upwards, then you should be drawing the trend line at the higher lows. Okay, so at the low side of the wicks. So just one thing to keep in mind. So don't take this slide like that, just for you to remember. I will show this a bit better on the actual live moving market in a bit. Now, the psychological, the round numbers are also and usually serve as really strong support resistance levels for your USD, like 1.1 and completely just plain bluntly 1. And you have some other examples here as well. So the more round the number or the price is, usually the stronger the support and resistance level is as well. Okay, this is basically just based on pure human and trader psychology, how they view and consider these significant price points. Okay. So now, how to apply the very basic practice, how to apply a very basic practice of trading the support resistance levels. What you can do, you can use the internet, you can use the web, just Google daily pivot points. These pivot points, they are defined and in each and every start of the day, and you will definitely be able to find a lot of different websites that do provide you the S1, S2, S3 levels, which are the support nearest 3 support levels, and you will be able to find R1, R2, R3, which are the nearest 3 resistance levels. Okay. What you need to do, you need to check and verify that there is no major news upcoming, and you can use pending orders also to trade these nearest support and resistance levels. As you can understand, the very nearest support level, in example S1, it has the highest risk because it's not as strong as the S2 or S3 in example. Okay, so how it goes would be the support levels are the levels below the price that support the actual currency on the underlying currency. And setting a pending order to go long at nearest support level S1 is something you can do in theory, okay? Although it is high risk because the chances of the nearest support level, the S1, of supporting the price actually is the lowest, okay? In theory, what you could do is set a buy pending order on S1, another one at S2 with a bit of a higher lot size, and another pending order at S3 with another bit of a higher lot size, okay? And set your take profits respectively at the nearest resistance R2 or R3 depending on your risk appetite. So this is a very simplistic and very basic approach to trading these support resistance levels. As I mentioned, the nearest levels, they are the weakest. The S2 is stronger than S1, but weaker than S3. And obviously, you know how it is for the S3. It's the strongest of those three levels. Now, it's not always wise to trade at the nearest support or resistance levels, especially if you see some high volatility in the price. It's really likely that the price might test the nearest support or resistance levels briefly and then simply break out and not even look back and just head to the second support or resistance level. Okay, so I would personally only consider to start looking for trading opportunities when the price is reaching the third support or resistance level, the S3 or R3. These are usually defined far enough from the price to actually carry any weight intraday. Okay. When you use these pending orders, then obviously you need to define your take profit and stop loss when you are setting the pending order. And don't forget these, because otherwise you're just initiating a trade and letting the trade run to wherever. Okay, so this is a really high risk to later on catch the price 100 pips in the other direction and you're about to hit your margin call. Okay, so definitely don't forget your take profit and stop losses. I would also wait for a breach of the support resistance level, at least maybe 10 pips, and then just initiating the trade. Okay, now obviously this is a very simplistic approach. There are a bit better ways to approach and incorporate support or resistance levels into your trading activities, and I will show a few of these on the live chart as well soon. Okay, so before we go to the next slide, let's just quickly jump into the MetaTrader 4 and let's draw some support resistance levels onto the chart. Okay, I hope you see my chart here on the screen now. If it is too small, then please don't hesitate to let me know. I will then just make it a bit bigger. But keeping it this small allows me to more adequately analyze the price movements and also identify the proper support resistance levels. Okay. Now, please note that manually drawing the support resistance levels onto the price chart, it might seem like a difficult task, but is actually really easy. It's a lot easier than you think, especially if you are already familiar with analyzing candlestick patterns or any other chart styles. It will be like a natural thing to you. Just look at the chart and you'll already know where the support resistance level is. Okay, so me just looking at the chart at this point, I already see that there is some support resistance level forming at this point. You see how the price was supported by this level 2 times. You have some indecision setting in here at this point as well. This is already just analyzing few weeks of the price movement. So this is relatively immature level based on this price action, but I see a support resistance level forming here. Okay, now what I will do, I will scroll back into the price history and see if this level supported or resisted the price movements in the past as well. Okay, so we can then see how significant even the past support resistance levels can be in the future price movements. Make sense? And when looking at the price, I also see another, oops, that was a wrong thing. 1 second. Okay, let's just redraw this here. Another support resistance level forming at this levels here approximately. You can see this level repelling the price upwards and resisting the price movement several times as well. Again, really immature support resistance level. This is a Euro USD 1 hour chart. Okay, so let's just go further a bit into the past. We see and we know that Euro USD has been falling frequently, quite significantly. So the levels I drew right now, we need to go quite a lot further into the back to see how this performed in the past. Okay, before that, if you look at this ranging market here at the top, okay, you can visually see that several times this was the very low point of the price movement and the wave, right? This point here. So you can easily set a proper support resistance level here, and later on when the price comes back up there in the future and you have that line drawn there, you can see and you can check if the price is actually repelled by this line. Okay, so just some tests you can do to see how the history or previous support resistance levels act and behave and direct the future price movements as well. Okay, so we can really easily draw one line here. Another support resistance I can see forming here because you have a lot of indecision at this point. Again, a lot of indecision at this point. You have candles with extremely large wicks, and yeah, the price is essentially at this level is bouncing the price really, really great. Okay, so we have another level here. So it only takes a bit of analyzing. It only takes a bit of a trained eye to easily find these levels. The easiest and most efficient visual part of the price chart, what you should be analyzing when drawing the price support resistance levels, are the peaks of or at the very end points of the waves that lie on the same levels, if that makes sense. Okay, so you have a drop here, you have wicks at this point, and here you have price coming up, and also in the same region, you know, the price is bounced down. Okay, so support resistance levels themselves, they are actually really accurate price points. You can also consider support resistance ranges, and these are already defined by supply and demand zones. This is actually an upcoming webinar that we have. It's a new topic that talks about supply and demand zones, which are really closely related to just support and resistance zones. But the support resistance levels, they are very accurate and defined levels. Okay, really accurate price points. So These support levels, support and resistance levels that we drew here based on this price action, you can see how these levels behaved in the past. Okay, so at these levels already you see a lot of indecision. You see these levels repelling the price away on several occasions. Let's see, we are talking about mid-April, and this levels already played a role mid-March. So 1 month prior to that, these levels already served their purpose. Okay, so these played a role in the beginning and in the middle of March as well. So if you drew these lines, if you define the support and resistance levels in the beginning of March, and the price, moved away from this level and came back, you see how these levels actually worked as relatively defined support resistance levels still, right? Okay. Now, one thing to mention about support resistance levels, it is said that the more time the price is repelled by a certain support or resistance level, the weaker it becomes. Okay, this is true to some extent. The way you need to look at it is if within a short time frame the price is testing that certain level several times, then yes, the weaker it becomes, and eventually the price breaks out of that, breaks further from that support or resistance. Exactly like it happened here. The price, it was bounced, we can say essentially 3 times until it consolidated here just above the support level. You have bulls and bears fighting what to do next, and then you have a breakout south and past this support level. Okay, so yes, after 3 bounces it became that weak that it bounced, or it broke out south. Okay, however, on a larger scale, on a larger picture, after you have defined some significant support resistance lines and the price moves away from those levels significantly, then when the price comes back to those levels after some time, then these levels, if they were strong enough to repel the price several times in the past, then these levels will most likely to do so in the future as well. Okay, so this is something to keep in mind, that on a larger scale, these levels are still valid. On a smaller scale, yes, they become weaker at each and every time they repel the price. Okay, so quite straightforward. So these are the lines that we drew here. We checked that these lines worked well in the middle of the March. Let's see further. Again, some indecision at these levels. Here you can see how really accurately the price was supported by this support level, and so accurately bounced up again significantly. Okay, and quite, 2 times here, 1 time here, and eventually it broke south again. Okay, so this is how you can draw these manual support, psychological support resistance levels by just visually analyzing the price charts and see how these levels actually behave and act in the future. Okay. Again, a resistance line that I drew in January based on the price action in January, because I see a lot of indecision here on price being bounced several times from this level. In the resistance line in January served as a really strong resistance point in the end of March as well. See, it's a lot of indecision, and the bulls didn't win this battle, and the price went down south again. Okay, so let's draw some trend lines here as well. One thing to note with trend lines is that you don't have to be extremely accurate, just only drawing it from the very tip of the wick to the next tip of the wick. They can be a bit upwards or a bit downwards because you need to just understand the general level range that the price can look to bounce from. Okay, now this we would need to wait for a third bounce from this level until we consider it as relatively a decent trend line. Okay, this is too far away from the trend line for it to be considered. Although again, I wouldn't really set so extremely strict rules for this. Trend lines, they are a bit, they should be more dynamically used in that sense. Okay, so let's take a look at this, just this upwards movement after the downfall here for a moment. Okay, so let's see, you have a bit of an indecision. The price is slightly consolidating, and we see already we see a higher low forming here, and you can start to think about drawing a trend line and seeing if that actually would go upward. So you would be able to use these 3 points, the very first one here, the second one, and the third one. Okay, as soon as the price bounces a third time and goes up again, you can draw your trend line. Okay, so if you use the actual very top of the wicks and would be really strict about it, and then you have the trend line heading at this point, which of course on this occasion it did cause a bit of, so to say, confusion and the fight between the bulls and bears, although it didn't really serve as a really strong point on this occasion, and the price broke down. Okay, however, if you so to say cheated a bit, not necessarily cheated, I wouldn't call it that, but would be a bit more loose with your conditions, not be too strict, and use perhaps the middle points of these wicks or just the low points of the candles instead, and just looked at the not only one candle but maybe 3 candles in conjunction and determine a middle point somewhere here, then as soon as the price arrived at this point, even if it goes a bit further down, it doesn't matter, but it would create a trading opportunity here. Okay, you see what I mean? If you would be too strict, you would perhaps lose out from this trading opportunity. But if you were a bit loose with your conditions, then it would be likely that you might have found this opportunity and entered the trade and gone long and reaped some decent profits, right? So I'm not a too avid user of the trend lines. To be honest, I more like these horizontal support resistance levels more, especially lately. But if you are using these, then I would recommend not to be extremely strict and not to be drawing these trend lines from the very tip of the wick to the next one in order to find where the price or where the trend line is headed. Okay. Now another example here. If you would be extremely strict, maybe if you even draw it from the second one, you would never really have a complete trend line properly, right? This is already too far for the third bounce of the trend line. If you were a bit strict, then you would consider this midpoint of the wick as a second touch of the trend line, and use this as a third bounce and trade it here and gone long. Okay, so this would have been a trading opportunity, although this point, the next bounce would not really be valid and not serve as a good trading opportunity. Okay, if you were a bit loose with the conditions, you would already consider this as the third bounce or the third touch of the trend line. And in this occasion, you would be able to enter your trade here, gone long, also here, gone long. But one trade per trend line, it is already good enough. Okay, you don't need to overdo it or look for additional trading opportunities. So this is how you draw the trend lines. Don't be too strict. Set your conditions and loosen them up a bit. You already know how to draw horizontal trend lines based on the price action and visually analyzing the charts. Let's do also the Fibonacci retracement tool. Okay, let me just zoom out a bit. Let me find a good place to draw it, just so we could get away with only one example, because we still need to have a bit of time for questions as well in the end. So the Fibonacci retracement tool. If you don't have this toolbar here, then you can easily go to Insert at the top left, then Fibonacci category, and there you have the retracement. Okay. If you have the toolbar here, it's really easy. You also have the draw trend line option. You also have the draw horizontal line option here. Really easy to access. And you also have the Fibonacci retracement tool here as well. Okay. So how to use the Fibonacci retracement tool? Let me just 1 second. I think I need to zoom out just a bit still. Okay. So you have this on the largest scale, you have this relatively ranging market if you look through several months. Okay. So what you will do, you will use this Fibonacci retracement tool. You will draw it starting from the very high peak of the previous wave, so to say, and draw it to the very low point of this next wave. Okay, so you go from high to low. Please bear in mind that my levels, they are a bit off because of the harmonic pattern webinar that we did this month. So you should have, and you most likely will have, different levels showing, different Fibonacci levels showing. Okay, if you want to know the very core or the very primary Fibonacci levels, if you have modified them yourself, then you can look it up on the internet. But even these levels that I have drawn onto the Fibonacci retracement tool, as you can see, I drew it from the high peak to the very bottom, and these levels, these Fibonacci levels, you see how well these levels serves as support and resistance levels. This level here, extremely well. Almost every time the price reaches that point, you have some indecision and the price bouncing off that level. It's so visible, right? On a very larger scale throughout several months. Again, this level here, you see how great the indecision is setting in. how well the price is being bounced off when the price reaches that level. So the Fibonacci retracement tool is extremely powerful if you know how to use it. Okay. Let's no. I think this example is serves really well. It gives you a really good visual idea how well these lines work. Okay. The Fibonacci retracement tool is based on the Fibonacci sequence theory. Fibonacci sequence is a very fascinating discovery. You can find it all over the nature in biology, flower patterns, whatnot. The Fibonacci sequence is really important and it's really mysterious. So I would highly recommend look it up on the web, read about it. Really interesting material. Okay, so 3 different ways um, to draw and to use support resistance levels in your trading. One moment. Okay. Please note that this webinar is recorded like every other webinar we do. And these recordings, they are uploaded on the website. If you log into the Hot Forex, into your Hot Forex account, go into the webinar section and select the past webinars. You will be able to find the webinars there. Just review them a bit more slowly. Incorporate that knowledge into your trading, learn it by heart, and then use it. Okay. So this is standard. All the webinars are recorded here. Anyways, now let's take a look at the risk-reward ratio or reward-risk ratio, no matter in what order you say it. If we're talking about reward-risk ratio, then you should keep the ratio at 1:1 or 2:1. Okay. If you are starting out, then 1:1 reward-risk ratio or risk-reward ratio is completely okay, but you should increase it to the positive side. Okay, this means that your take profit is either the same distance from your stop loss if you're using 1:1 ratio. If you're using 2:1 ratio, then your take profit is 2 times the distance of your stop loss. That means that you will be able to win more than lose. Okay, this is really important. Over time, you should increase that risk-reward ratio, but don't set it too high, otherwise you will never hit your take profit levels and the price most likely will reverse and you will hit your stop loss instead, or you will just be, your trades will be lingering around forever. Okay. Another thing you can use is dollar cost averaging. This is essentially simply building up your position. If your usual standard trade size would be 1 lots per trade, then you will initiate 3 or more trades instead of that 1 trade and average out the lot size between those trades. So first trade will be 0.3 lots, second will be also 0.3, and the last trade will be 0.4 lots, in example. It all still equals to a lot size of 1, but you're initiating several simultaneously open trades at a time, and each trade will have a better price. And you will only initiate the next trade if the price moves against you. Okay, this isn't really not exactly the same thing as martingale. Martingale is dangerous, it's strictly not advised. Martingale is when you double up your position, your standard position, when the price moves against you. Okay, but this is gently building up your position that you would use by standard on your normal trading activities. Okay. excess gains. You can use trailing stops, although I wouldn't recommend it if you are scalping. If you're scalping, you're aiming for these low pip gains, like 15, 20, 25, 30 pips. Then trailing stop would not really be effective here. If you are a position trader and are aiming for these larger pip gains, then a trailing stop can be a really useful tool. You can essentially set and forget. If the price has moved in your desired direction, let's say 30 pips already, and you feel the price can move further still, you can set your trailing stop to the very 0 point or the start point of your trade, if that's a 30 pip trailing stop. Okay, so if the price moves again another 30 pips to your desired direction, then the trailing stop would have moved along with the price to the very 30 pip mark. So whatever happens from that point onwards, you can be sure that you have earned 30 pips of profit, because the trailing stop, it will move along with the price if it's going further into the positive side. Okay. Uh, I will show how to draw a trailing stop in the MT4 as well later on if you need. Now, currency trading dangers. Let's go through them quickly. Don't trust bots. Most of them are designed to generate losses in your trading account. Be careful. If you want to try to use one on a demo account. If it has been successful significantly and stably for 3 or 4 months, 5, only then you should really consider setting it up on your live account. Okay, and before even jumping in, just do significant research and background check to make sure that there are no scam reports about that certain expert advisor or a trading bot. Okay. 5 of 100, sorry, a spelling mistake. Essentially 5% of all the retail traders make money in FX on the longer term. And this is because of human psychology and human emotions. Okay, we have a separate webinar about human emotions and what happens in your brain if you win a lot of times in a row and if you lose a lot of times in a row. Especially beginners, even intermediate and expert traders do experience certain chemical reactions happening in your brain if you win a lot or lose a lot. Okay, and when this happens, it's really, really difficult to control yourself. You usually will end up over trading if you are winning a lot, and you will eventually make silly mistakes and either lose all your profit or empty your account or just end up in some losses. If you're losing a lot in a row, then you might end up revenge trading. You want to earn back what you have lost before, but as your brain essentially is a chemical mess at that point, then again you're really prone to making a lot of big mistakes and causing even more damage to your account. So it's extremely important to set your trading rules and be really strict. Okay, so depending, of course, on your risk appetite, your trading style, you should be really setting certain targets for each and every trading session. You can keep them static across all the sessions. Let's say every session you are trading in, you want to earn 100 pips of profit or accept the loss of 50 pips. Okay, in this case, you will keep your general risk reward ratio 1 to 2, which means that you're expecting to win 2 times as much as you're expecting to lose. And as soon as you reach those targets, either one of them, you will simply stop trading and walk away. Okay, this way you will not damage your account enough to not be able to trade the next session. Okay, so close down your programs, walk away, take a breather, and come back in the next session. And this way, you will have enough account balance left to, so to say, make a comeback, right? So the next trading session might be successful. You will actually reach your 100%, 100 pip take profit target. In this case, when you combine these two sessions, you will have 150 pips, right? So you won 100 pips and you lost 50. Okay, so in this case, you can endure two losing sessions and simply accommodate this with one winning session. Okay, so be really strict with the rules. This is just one of the very plain examples that I brought out with setting the rules straight. Another thing is that if you empty one or two accounts, it's not necessarily a bad thing. Believe me, most of the professional, if not all, the professional traders have been there. Everybody is a beginner when they are starting. So it's okay to make mistakes, but it's better to learn from others' mistakes, right? Now, if you empty one or two accounts, it's totally fine. It's part of the journey. That means you need to change something. Change a part of your trading strategy, either how you manage your money, how you manage your risk, what session you're trading in, and all um, that makes a strategy. Anything that is inside the strategy, you just change the bit and try again and see how it goes. Okay. The last but not least, 5% of the signal services and signal rooms are legitimate. Sad but true. If you want to engage in some signal services or signal rooms or trade by somebody else's signals, then please do a background check, ask for an audit trail, ask for a performance record, and see how many scam alerts this certain signal provider or service has, if any, and how many complaints you will be able to find. And based on that, make your decisions and use a demo account at first. Okay? So we are hitting the 1 hour mark, and again, explained a bit too much on some point. So I will take questions now. I see already a few questions in the question section. Let me just bring them up and start going through them. One moment. Okay, Ollas is asking, most of the S1s and S2s, perhaps, they are broken. And how many pips do you take into account before you consider the SR level not to be broken and the price actually reversing? What you can consider is around maybe 10 pips, 15 max, if you're looking at a certain visually strong support resistance level. Okay, so if it passes that level by 10 or 15 pips, that would be okay, and look for entry opportunities. If it passes more, then I would not really risk trading to against the price movement there. Okay, Rodolfo is asking about the double top and triple top patterns. We don't really have much time, or any time at all to go into specific patterns, how the price acts at the significant support resistance levels. But what I can say briefly is that yes, very often you will see the price testing that support level before, or 2 or 3 times before it bounces back, before it before the level is actually repelling the price. Okay, but there is really no this kind of definitive rules, how to trade that. It's more of an observation game. Will require a lot of chart pattern analysis, a lot of support resistance analysis in order to benefit from the triple tops and double top patterns. Bruce is wishing to use a line graph to draw support resistance levels. Bruce, sorry, but we, and I personally here, and most of us in our group, we use candlestick patterns because these candlestick patterns, they do provide a certain candlestick formations that help the trader to find proper reversal points. For example, dojis, shooting stars, hammers, etc. We don't use really line charts to trade. So I would highly recommend to look into candlestick patterns as well. Okay, Mohammed is asking, what is the best SR for intraday trading? Can you give a general overview how to utilize the SR levels for intraday and what chart time frame to use? I use 1 hour charts to trade intraday. Most, if not all, my trading decisions are based on 1 hour charts. Sometimes I zoom out, sometimes I zoom in, just for a better overview and better timed and accuracy trade. Now, trading the SR levels intraday, I do analyze visually the price action for the past few weeks. I'll find the support resistance levels that I'm able to properly define, and then I will observe those levels and see if the price hits those levels intraday. Now, support resistance levels I accompany into any trading style I do. Any strategy that I use also incorporates SR levels. SR levels are so fundamental in trading that you cannot really ignore them. Okay, even robots and machines trade based on these support and resistance levels. The robots and artificial intelligence units that the large banks and hedge funds have, even these to take as the support resistance levels into consideration when going through or analyzing their information or the price charts. So this is something you cannot ignore. Okay, so draw them manually yourself. I would highly recommend use the Fibonacci retracement tool. It's really powerful. And we have a Fibonacci retracement tool webinar, retracement webinar as well, that will go a bit further into how to draw it again and how to utilize it better. Sergio is saying that there are no recorded webinars for the past few weeks. I will certainly look into that and inform the right departments to make sure that these are updated. Izumuna is asking, how do we calculate the take profit and stop loss levels? That is a good question. The thing is that your take profit and stop loss levels should be determined your trading style. okay, and what strategy you're using. If you are a scalper, if you initiate a lot of up to 10 uh, short time frame trades per day, then you would most likely be aiming for these 20, 25, and 30 pip, maybe 50 pip gains tops. But you are initiating a lot of trades on a single trading session. It's more about the risk reward ratio. How far is your take profit in relation to your stop loss? Okay. If you're starting, setting the risk reward ratio to one to one is a good solution. So that means your take profit and stop loss levels are equal. But if you become better, raising the risk reward ratio to the positive side is definitely recommended, which is then 1 to 2, for example. Risk reward ratio means that your take profit is 2 times the distance of your stop loss. So if you're a scalper, you're aiming for a lot of small pip gain trades. If you are intraday trader, obviously you're perhaps aiming for these 100 pip wins. If you're a position trader, then even more. So you need to define that yourself. Heather is asking, how do you recognize overbought and oversold market? Now, the question itself is good. I'm really glad that you are, thinking of the oversold and overbought status of the market, although there are so many things that help define if the market is overbought or oversold. The very first things are technical indicators. If you use them on a larger time frame, an example, they will show you if the price is in the overbought or oversold status. Another things are supply and demand zones. Essentially, it's really similar to support and resistance. There is really no single way how to know whether the market is overbought or oversold. You just have to use the tools that have been provided to you, like the RSI, like the statistics. These two are the most common indicators, technical indicators, to show you or help you determine the overbought and oversold status of the market. So whatever you have in your arsenal, then definitely use it. Vincent is asking, how do you come up with a strategy using Fibonacci? Well, there is really one single way how to use a Fibonacci retracement tool. You cannot draw it randomly on the chart between some random movements. You have to draw it from peak to peak, okay? And you have to look at the larger picture to determine these general and high capacity waves where you can use this Fibonacci retracement. So if you have a significant drop in the price recently, you will need to draw the Fibonacci retracement tool from the start of the drop, essentially from the peak of before the drop, just before the drop, to the very low point, so to the at the very end of the drop, okay? And this will show you these Fibonacci retracement levels and these potential retracement points where the price might retrace to, and also these levels serves as really strong support resistance levels. Okay. Okay, let me see if I can quickly show you how to draw. Okay. This is a demo account. Okay. Okay, that was a bit off. One moment. So let's go to the current price action. Let's say I'm going to sell the market, right? So one way, you initiate the trade, you right click on the trade, and here you already have trailing stop. Okay, so here is the one way you can set a trailing stop your trade. Let me do it for, okay, 40 points is a bit too little. Let's do it for 200. Okay, sorry, not too little. Anyways, let me just delete that here. So here you can set it. Essentially, if the price moved in my direction, then the stop loss would form, will be defined, and will move along with the price. Okay, this is one way. I'm going to cancel this. Let's close the trade. The next thing you can do is when you go to new order, you go to right click on the chart, trading new order. Let's just do this quickly. Stop loss, whatever. Let's put it to 0. So, okay, if you enter the trade like that, you define your take profit and stop loss levels already. I mean, again, this is how you can manually set your stop loss levels and also the take profit. You can manage them on the chart. Now, if the price moved, one second. No, one chart provider did provide the option to set a trading stop on the chart as well. But I mean, this is your easiest shortcut. Just right click on the trade and set your trading stop from here. Okay, we are way past the webinar time at the moment. So thanks all for attending. Sorry it was a bit lengthy again this time, but I'll try to speed it up the next time. We'll see you next Thursday. Take care.